And I think the IMF quite good-humouredly also refer to the fact that there is a huge disconnect between markets and where they see the fundamentals. And essentially, like you summed it up, the hit has been worse and the recovery will be slower. And that appears to be already coming through by looking at the back and forth in the reopening.
Vishnu, how material is a downgrade like this for investors? You mentioned there seems to be a gap between equity valuations and economic fundamentals. Perhaps that gap has narrowed in the past 24 hours, but it still exists. Why is that the case?
Well, Matt, I mean, I'm totally with you on that one. The narrowing over the past 24 hours is but a drop in the bucket. And really, I think that derives from the fact that your reality is defined by what you're looking at. And for markets, they're looking at the sheer amount of liquidity that central banks and governments have put through. So even if markets know and concede that the earnings recovery are not going to keep up with the equity market valuations, they cannot ignore the sheer deluge of liquidity, and money being fungible is going to find its way into the asset markets. So now we're really caught between money that's going to chase yields and equities as part of that, and the vulnerabilities to sudden reversals because of the mismatch between fundamentals and valuations. And that's something that we enter this stage with our eyes open.
Do you think that the IMF is perhaps a little bit too pessimistic when it comes to some of the outlooks? A 12% contraction for a number of European countries.
I think, the risk, and this is a backward-looking thing, but if we look back, and when the April forecast initially came out, we thought, hang on, isn't the IMF being a little too pessimistic on most nations except India, I suppose? And now the risk is we would repeat that statement and only to be disappointed by the fact that the reality is quite close to what the IMF is looking at. I want to put another frame on this. I mean, if you thought of GDP as the net income of a nation, then the ability to recover back all of the lost wages, profits, interest income and rentals by 2021 does look a little way out. And for that reason, the IMF's notion that there won't be a full recovery into 2021 in terms of levels and incomes does make sense intuitively.
Yeah, that recovery, 5.4% in 2021, is that about on the money, do you think?
I think we could hope for that. And that 5.4% recovery, we have to bear in mind, would still be some way of a full recovery for the global economy. So it's nowhere near coming to that. But it would make up some ground, and that's where we are. So that's really not a V, even if it appears optically to be one.